first of all, thank you so much for arranging this wonderful conference. I'm so sorry I couldn't be in Budapest. I've been looking at the programs and the themes that Jens has been sending out in awe. And right this morning when I woke up here to prepare, it was -1 degree and not snow, but almost. So while looking at the wonderful weather in Budapest, and of course all the wonderful colleagues there. But I'm very grateful for being able to participate in this way online. And thank you so much, Professor Cognac, for the wonderful presentation on France. It's very, very interesting to hear. And it sounds like I've missed a very interesting day yesterday. And I am Associate Professor Erik Lidman, and I should say that now I'm at the Stockholm School of Economics rather than University of Gothenburg. And my closest colleague there is Professor Rolf Skog, who I think many of you might know. And I'm going to be fairly critical about a lot of things going on in the EU on the sustainable corporate governance area. So first of all, I'm going to talk a bit of how incredibly sustainable Sweden are to show you that it's not totally unnuanced here. If you've had the chance to look at the country report for Sweden, you can, and it sounded a bit like that might be the case in other jurisdictions as well, that there are a few areas that one might expect regulation in that there in fact aren't. And just for the avoidance of doubt, then this isn't the case that sustainability issues isn't an important focus on the equity market or in the financial sector in general. And with regards to the kind of three pillars of sustainability that we at least have as a discussion framework in Sweden, that is environmental, social, and economic sustainability, Sweden is performing quite well. And these are a few of the ratings that I found on Sweden, or that's usually referred to in this discussion in Sweden, on the Robeco country sustainability rating, which is, I think, the largest private sustainability rating targeting investors. Sweden ranked on second place of 150 ranked countries, beaten by Denmark, that we will hear about in a bit. The same in the Yale Environmental Performance Index. I think we placed on, we placed on eight out of 180 rated countries. The gender gap report, also quite a good placement, and low corruption, fairly good innovation, one would have to say. And in the Global Sustainable Competitiveness Index in 2020, Sweden was ranked highest. And this is also, more concretely reflected in corporate behavior, of course. And this it might be said that I think that an underlying reason here is that Swedish companies have a good track record for being socially conscious. So 90% of the largest Swedish firms apply the GRI, the Global Reporting Initiative's standards for sustainable reporting, while the benchmark figure for Europe in general is 67%. 80% seeks external assurance on sustainability reports. 51% is the EU benchmark. Asset for pillar score on environmental performance is 72.74, and the CSR Hub rankings are also quite excellent. So I think one can make the case that Swedish firms are trying quite a lot to both act and perform and conduct sustainable business, and also to disclose and get assurance on those types of activities. And in politics, of course, there is a very large room for improvement and a need for improvement, but in general, Sweden and Swedish industry turns out to be a best-in-class performance on these measures. And this is also heavily reflected within politics and legislation, and I dare say a result of being in the fortunate position to be able to focus on social and environmental and economic sustainability since the Second World War, basically. There is always a strong drive and a political drive and a public opinion that drives towards doing more than outlined in international frameworks, as for instance the net zero goal in Sweden is, I think, 10 years ahead of the goal within the EU. And sustainability is, of course, also then an important focus in the financial sector, with one of the FSA, Finansinspektionens, the Swedish Financial Supervisory Authorities, special focuses for this year and the last years being environmental and economic sustainability, and this is not just a commercial on their behalf. They have a few, 3 or 5 focus areas that they focus very deeply on and devote quite a lot of resources to. So that's one of the supervising authorities' key areas. And I think it's also just like it sounds like in France, that it's important to note that that politicians and policymakers have never shied away from introducing long-going and rules that are difficult to comply with, and regulation for businesses to achieve sustainable development when needed. But this has generally been in the areas of tax and labor standards and education and environmental protection and so on. And also generally these initiatives are supported by industry leaders. Now, with this background, okay, I dare say that the general Swedish perspective, both from politicians and policy and industry, is that many of the EU's capital market sustainability initiatives are, well, quoting here, fundamentally flawed to the extent that they risk being counterproductive. It of course doesn't apply to all such initiatives, but at least recently to surprisingly many. I've listed a few of them here. And I don't have any intention, of course, on going on into details as in the country report, but I thought I'd rather focus on why there is this aversion for the European, not all European initiatives, but quite a few of them, at least. And the starting point in the Swedish debate on regulating the financial markets and the equity market in particular was established in the 1980s, and it's pretty clear when you follow the preparatory works that that's where we end up when we follow this. The idea then, as now, was that a vibrant equity and financial market does not only provide ordinary households with opportunities to diversify their long-term savings and supply companies with equity capital, as well, of course, as growing pensions. They also serve as an important contributor to solving societal problems today, such as the climate crisis, of course, and the need for sustainable innovation. And I think this is captured pretty well in the quote on the screen here by Mats Isaksson, who was the head of the OECD Corporate Governance and Corporate Finance Division. Broad and deep public equity markets that present investors with the ability to diversify the firm-specific risks associated with technological innovation, lower the overall societal cost of capital for research and development that result in new patents, products, and processes that have a smaller carbon footprint. And I think here we could in the end add also that in a different way contribute to sustainable development in other areas as well. And this isn't a political platitude by any stretch, and I dare to say that this is really the political focus when regulating finance and equity markets in Sweden, both from top politicians and to government officials. And the reason I couldn't join you in person was that we have a joint research project with the OECD, where a delegation was here in Stockholm the last few days on a fact-finding mission regarding the Swedish high-yield corporate bond market. And when we talked to those responsible for debt markets in both the central bank and the FSA about the motives, why are they moving on this market and trying to understand the problems and trying to come up with regulation, they respond like that, that of course it is to ensure that we have an efficient market that provides companies, and particularly here in SMEs, with capital at the right cost. So this is really the attitude that you'll find in most, at least, regulatory bodies in Sweden. And on the practical note, there isn't an official document on how to regulate this, but this has meant at least that there is a strive towards keeping barriers to entering the public equity and bond markets low for issuers, while trying to balance it with strong minority protection and transparency to promote investor trust. And on the investor or the shareholder side, to promote and respect shareholder heterogeneity and be mindful of the incentives and, of course, ban bad practices. So in other terms, trying to focus here on market-friendly requirements, getting issuers and market participants to provide information and documentation for the market, and to be transparent, both with regards to this documentation and financial reports, and of course also pricing, and often relying on comply or explain rules, which also is viewed as a sort of an information rule. And then bad behaviors, specific bad behaviors that are perceived to either be directly value destroying or indirectly value destroying by being harmful for market confidence or efficiency are banned. And this has worked pretty well, or we don't know if it has worked pretty well, but at least it hasn't done any damage apparently to the equity or bond market. So this is the Oxero report from 2020, showing both the equity market cap as a percentage of GDP and the net listing in Sweden for the period 2010 to 2018. And I can assure you that the figures look even better if you have newer data. We have a very good listing climate in equities and a very strong bond market as well, or growing rather, I should say, bond market as well. We have, I think today, around 1,100 listed companies, and just in 2021 we had a total of around 190 IPOs, of course of varying sizes, but quite a few of them were very large. Just shortly on the bond market. Same thing here. The size of, and this is the non-financial corporate bond markets, it today has a value of 80 billion USD, so it's the largest one in the Nordics, quite far from the largest one in the EU, of course, but still a sizable market. And the growth rate is one of the highest internationally as well. And the number of unique issuers, I think today is around 70, so it's also in that sense quite a diverse market, at least. And now I'll go on to the theme for the study then. The national report, or in the national report, I've tried to describe how this connects to the different areas covered by the study, and I won't, as I said, go into any details here, but I'll try to say something on each of these themes, on how this overarching way of regulating and viewing sustainable finance and sustainable equity markets relates to these areas. If we start with then sustainable ownership, the EU initiatives on this area, or in this area, the starting point, if we go back to the Shareholder Rights Directive and back until the early 2000s, has been to foster long-term shareholder engagement. This is perhaps not as apparent in the most recent EU initiatives, but this is still something that we have had and still have, of course, in Sweden, as long as we have had a modern equity market. So it would be wrong to say that it's something that has been fostered through regulation or legislation, but nevertheless, the national approach here has been to be mindful of engaged owners and not create practical or regulatory obstacles for their engagement, and to create incentives to engage where possible. And this is perhaps most clear in company law, as in contrast to France, shareholder in Sweden, and I think it's true to say in all of the Nordic countries, or not a shareholder, but the general meeting has the right to decide and intervene in any area of the business of the company, and can basically overrule the board on not exactly everything, but almost everything of importance, at least, down to as someone usually says, down to, from the election of board and remuneration levels to the color of the pens used in the boardroom, and that kind of a governance structure and regulatory framework really is the prevalent thing you'll find repeated everywhere. That is very important, that the shareholders have these rights and they are able to utilize them, and that there can't be obstacles, either legal or economic, to this ability. So at the same time, when it comes to shareholder engagement, it's also recognized that not all shareholders are equal, of course, and that there are several economic antecedents for shareholder engagement. And these include those listed here that I think are fairly controversial and well understood. First of all, we don't expect a very small shareholder to engage. It's usually the rationally at least, the large shareholders that engage, those holding a significant stake in the company. In the experience in Sweden is 5 to 30% is a minimum requirement for true and high quality engagement. This is of course a quite large span, but the important thing to note is of course that almost all shareholders are not holding these type of stakes. The second antecedent, if we can call it that, is that of the size of the holding in relation to the investment portfolio. Basically, even if you hold a fairly large stake in a company, you might still not engage if it's only a very, very small part of your overall investment portfolio. And I think a interesting example, or a unique example here, is of course the Norwegian Oil Fund, that holds not, I think, 5 or 10% in that many companies, if any, but at least a few percent in almost all of the 40,000 listed companies we have globally. I think the average stake they had last time I checked was 1.7%. And of course, still, they don't have the resources or the capacity to engage with all of these companies. The next one ties slightly to this: a necessary corporate governance and branch-specific competence to engage. Not even if you hold large stakes, stakes in a firm, it's not necessarily the case that you have the ability to engage. And this, of course, also ties to the compensation for engagement costs. That, first of all, it's more expensive to engage than to not engage. And there needs to be some economic incentives built into the business model of the shareholder or into the market that ensures that if you engage, some of the free rider problem is alleviated. Finally, an efficient market for corporate control. And this isn't really an antecedent tying to the individual shareholder, but rather the market. If, first of all, of course, we're all familiar with the disciplinary effect of the market for corporate control, but also to ensure that shareholders can acquire the type of stakes that they need for it to be interesting to engage, and for them to be priced correctly and to be liquid enough. So moving on to some of the areas, at least, that are covered in the report on sustainable ownership. First, something about engagement policies. We got this rule through the Shareholder Rights Directive, and it's had very, very little impact in Sweden. Since around 2005, and in many cases a bit earlier, almost all large shareholders and investment funds had these type of policies, which were then called ownership policies, and it did not have any effect on behavior, the new regulation then from the Shareholder Rights Directive, other than that it standardized the policies that are now present. This can be a good thing. It of course makes it easier to compare investors and compare funds when you choose through what intermediary to invest, but it can also be viewed as, and sometimes is at least here viewed as, a negative development, since what we really want when you talk about shareholder engagement is not standardized box ticking behavior, but we want adaptive and tailored engagement to the individual company, ideally at least. And this, if it has any effect at all, it might at least be that it doesn't drive engagement in that direction. Then another area in the study, shareholder cooperation. This is also highly common in Sweden, and the dynamic here is basically that almost all companies has a large block holder. Not all, but almost all. That holds somewhere in between 10 and commonly 10 and 40% of the shares in the company, depending on basically on the size of the company. And this has been working as a catalyst for other type of investors as well to engage, either opposing the large shareholder, banding together to have a different agenda, or working with it's. You can't say that one or the other is more common. It's very individual for the company and the issue at hand, but it is still a catalyst for engagement, much like the activist funds that we have in some jurisdictions. And a fear that's raised in this cooperation, which in specific almost always relates to election of board and to remuneration policies and incentive programs, is that there is a fear that this might be viewed, especially when it comes to board election, that if you do this from one year to another, and we have several very large public pension funds that invested, I think, 16 billion euro together in the market, that if they engage over and over in the election of board, that they might be viewed as acting in concert, and that they would then have to put forth a mandatory bid. So this is a problem that is discussed. This has never happened in Sweden, but we don't know if that's due to this actually not being a legal problem, or if this is due to investors tailoring their corporation to avoid this. But it is at least perceived as a problem, and a welcome initiative that's sometimes discussed is that it would be nice if the takeover bids network were to address this, even though it's a very, very difficult thing to do at a harmonized level to kind of address what behaviors aren't to be viewed as acting in concert in this sense. With regards then to the efforts to get shareholders from foreign jurisdictions to engaged, this is very much aligned with the view on how shareholders are to behave, but it's also, and that's generally positive, and at the same time, it's also a challenge at some points, particularly when you have foreign investors that do not use national advice or national lawyers and don't understand the national governance models, which sometimes mean that they vote in very, very strange ways. And there are quite a few issues that the general meeting has to decide on with a supermajority in Sweden, and particularly in those cases where they are equity-based incentive programs, or what we call discharge from liability. There are instances when institutional investors from especially the US vote against what is to be perceived or what's generally perceived to be in the best interest of the company in a way, and the experience at least is that this is not due to actually not wanting these things to pass through, but simply not understanding what's properly what's being voted on. And of course, this again ties back to the problem when a fund holds shares in 14,000 companies all around the world. It's difficult to understand all the nooks and crannies of the local corporate governance systems. With regards to creditors' role in corporate governance, I knew nothing about this a few months ago, but now I can be, thanks to the OECD, we can be fairly certain that there is nothing going on here in the Swedish market at all of interest in this context. The bond market has grown in very, very rapidly, as I showed in one of the previous slides, in the last 7 and 8 years. And the structures are just being developed on how to handle this. So from a EU perspective, I think it would be, or I know it would be very, very welcome with an initiative such as the one we're partaking in now, with a kind of a mapping of how are bonds treated in different jurisdictions from a corporate governance perspective. And the OECD is doing some work on this in their G20 principles on corporate governance. But this type of comparative study would be super helpful, both for the market and for the regulatory authorities. But we're certainly not ready for any regulation or any regulatory initiatives from the EU before we fully understand the own market. And finally, a interesting point brought up in the general remarks for the study was the regulation on investor dialogue and the conflict of equal treatment with regards to information to shareholders, which is a very common practice in Sweden. Between that the board has a dialogue with the large shareholders, the largest blockholders, as well as the most important or the strongest institutional investors, particularly the large pension fund or large pension funds. This is an area that's particularly interesting to me because I've written quite extensively about it, and I will be very happy to discuss if someone else in the audience finds this or of the participants find this interesting. But in short, it follows from company law that unequal treatment with regards to information is illegal if it gives an unjust advantage to certain shareholder at the cost of the company or other shareholders. And that we're saying unjust advantage means that if it's motivated as a business decision, it's fine. So a dialogue between the board or management and selected shareholders outside of the general meeting is legal as long as they are carried out in the interest of the company and not in the interest of certain shareholders. So, for instance, in the area of sustainability, if there is a discussion on kind of taking an action that is not perfectly aligned with the business purpose to create profit, there wouldn't be an issue with anchoring this with the large shareholders and see if they think this is a good idea or not. That's it on sustainable ownership. Then on sustainable funding, and now I'm kind of already moving to the end here, and this because there is much less regulated and written about this, the later two categories, as compared to ownership. One of the questions raised in the study is if there is a conflict between portfolio strategies and ESG. And this short answer here is pretty much the same as with shareholder engagement. Shareholders don't engage in general, will generally not engage in a specific company in their portfolio with regards to ESG factors. However, just as I believe to be the case in most jurisdictions, most funds have investor policies, which means that they do not invest in companies that are not performing well or aren't in certain categories on sustainability metrics. So it's not a matter of governance in the relationship between the fund and the company, but rather between the investor and the fund and the fund. But no regulation on this level, and no discussion of regulation on this level. On the conflict between sustainability and client interests, of course, there is a conflict here between sustainability performance and high return, and it's sometimes insinuated, and I don't know if this is something you discussed yesterday, that there isn't a conflict here, but first of all, then it wouldn't be a problem, and second of all, if and sustainable investment is a subsample of the total set of investment opportunities, it's very hard for me to imagine that we could end up in a situation where those bound by rules on how they may invest are outperforming those that aren't bound by rules, since the latter could just adapt to the former freely. And I think that's the general perception, or I know it's the general perception of this problem in Sweden as well. This isn't regulated either, and the client chooses the funds they prefer and choose between, rather get to choose, and the understanding that are you prepared to take a lower return in trade for a more sustainable investment product. And my understanding is that this is also a part, or quite a large part, of all the large banks' advice and in their know your client procedures. Shortly on the special creatures of index funds and activists, there has been no discussion on trying to force index funds to engage or act differently than other investors, or act like other investors perhaps. An interesting discussion that is ongoing is that of index fund governance, where the largest institutions that manage index funds try to either affect policy, so they aren't engaging with the companies, but rather the exchanges and how they want the regulation to look. And of course, a sort of regulation through steering company behaviors with the indices, such as in the area of dual class share structures. But this debate isn't mainly a regulatory debate. It's a self-regulatory debate and a debate on the exchanges in Sweden, but not in public policy. Finally, activists. There are no activists in the sense that that we usually talk about them in the corporate governance discussions. And the reason here is probably that almost all companies already have one or several large block holders that then aren't activists but long-term investors. So the room for activist business strategies is pretty limited. Finally, then on product governance and sustainable trading, there's very, very little on this in Swedish debate and understanding of it. It's not a big discussion, but it is a discussion within the bank, the banks. The new rules requiring financial service providers to take sustainability-related objectives into their analysis of the target customers is not a broad discussion, but an important discussion. And I heard that there were about 100 bankers meeting to discuss just this, representing several or all of the large banks and several of the small ones. There is of course no implementation on this yet, and it's discussed how it's to be handled, but it's really perceived, at least from the banking sector, to be a big problem on how to balance risk returns and now sustainability in financial product production and distribution, and not the least since it's perceived to be a risk that when the market turns at some point, if it does, that the banks would be sued to a quite large extent for not being good enough at handling this process. And so basically, if you choose a product that's tilted towards sustainability at the cost of either higher risk or lower returns, that you would get group lawsuits against bank on this ground. And so I would be very keen to hear any discussion on the view in other regulations on this. With regards to fees for sustainable products, also no specific regulation in this area. This is today, as far as I know, only held in client advising part of the distribution of assets. And also, as far as I know, or as I understood, the good market practice is that funds are very, very clear on and transparent when they take an extra fee for sustainable products. I went to there are 5 dominating banks that I don't know the market size, but I would guess 95% or something like that. And when you go through their online tests on what products they recommend, all are very, very clear on the cost that you pay for having a sustainable product. Greenwashing is finally, that's a big discussion right now, since the FSA has made it one of the focus areas for 2022, and they have announced that they will make carry out a very large market review on practices in this area that I'm sure has made quite a few funds nervous. Best practice today is, however, that you follow GRI standards and seek external assurances on sustainability performances. So I don't think there is a great expectation that this will be a big problem, but you never know, and I think we will find out during this year. Finally, a few main points of discussion in Sweden that weren't directly included in the report, but that I touch upon in the study. One is the regulatory burden from the EU in this area. I've said everything that needs to be said about this, I think, so far. Another is, but this is, I think those engaged in this discussion, they've spent quite a bit of their time on this issue and how to try to get the Swedish perspective on this accounted for more generally in the EU regulatory process, and that there needs to be proportionality and flexibility in these frameworks to allow for national differences in corporate governance system. Another discussion is to balancing ease of access to the stock market with investor and minority protection, especially in MTF listings. Quite a few of the listings we have are on the MTFs, and there is no data specifically on this as far as I know, but it's pretty clear that the case might be that the threshold to the MTF segments in the market are perhaps too low, and how to balance, on the one hand, the interest of supplying SMEs with equity capital and allowing outside investors into these firms to a low cost, while at the same time assuring market confidence, especially if we, as it looks like, are moving into a more high interest climate. And then the final discussion that I've already touched on is bondholder governance. There is no regulation in Sweden now, and it's interesting to note the G20 principles actually include this in the framework, that the national corporate governance framework should be complemented by effective and efficient insolvency frameworks, and by effectively enforcing creditor rights. And we don't know if that's the case in Sweden or not, but it's an ongoing discussion, and we will have regulation on this, I think, within 1 or a couple of years. That's all for me and for the Swedish report, and thank you so much for the opportunity to present this, and I'm looking forward to hear the other presentations and comments.